How's it going, everybody? Matt Diamond with Kalshi. Today we're doing another strategy video. This time we're going to be highlighting MACD and how to use it when trading the S&P 500 daily and weekly contracts and the NASDAQ 100 daily and weekly contracts. So let's start off with the basics for those that don't know. What is the MACD? The MACD is a moving average convergence divergence, and it's a trend following indicator that shows the relationships between the exponential moving averages, the EMAs, of a security's price. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. The result of that calculation is the MACD line. A 9-day EMA of the MACD line is called the signal line, which is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. So this can sound very complicated, but really we're going to keep it as simple as possible because that's the best way to use indicators. And every single time these cross, that could be a potential signal for a buy or a sell. Now remember, there is no such thing as an indicator that works 100% of the time. It's all about trying to keep it simple and then realizing it's just a game of probabilities at that point. So now let's talk about the actual strategy, and I'm going to move my face for a second. At the very bottom of the chart, this is the MACD, and I know that there's some green colors, there's some red colors. It looks a little confusing. There's bars that are hard to understand or not sure what they're there for, but we're going to keep it extremely simple. The main focus when I'm going to be talking about the MACD is these two lines right here. And essentially when they cross, those are going to be areas where there could be continuation in an uptrending market or a pullback. So that's the information we're going to use to come up with potential trades. So now looking at the far left, the first area where this kind of crosses to the downside is going to be right here. This is the daily chart of the S&P 500. Look at where that coincides with the pullback. So I know nothing works 100% of the time, but this one happened to work pretty well when it crossed to the downside and that blue line starts to go down below this light yellow line or this tan line. That's when that first pullback happens. And now keeping it very simple, where is the next time that these two lines cross? They cross right here. So the blue line crosses above it. And this just so happens to be an area where it finds a little bit of support and there is a short-term move to the upside. Now let's continue. Where is the next time that the lines cross? So the blue gets over that tan line, and then here's where it crosses again to the downside. And then it just so happens that it coincides with that spot right there, which leads to a short-term pullback. And here's another example of the blue line crossing over that tan line, which happens to be this area right here, and leads to a short-term push higher. And there are a handful more times where there is some sort of crossover here. Now, a lot of these moves higher or lower aren't very big, but we're just keeping it very simple and realizing that when these lines cross, there is a high probability of there being a continuation to the uptrend or a possible pullback. So now let's go structure the trade. So as far as the first example that I gave, where the blue line crossed to the downside and the market pulled back a little bit, if we believe there's going to be a pullback, then we're going to want to trade the yes shares to the downside because the likelihood is that it's going to get to these lower areas, and then vice versa, trade the no shares to the upside because if it pulls back, it's not going to get to those higher prices. And now here's the opposite side of that. So if the blue line crosses to the upside above that tan line, and we believe that the market is going to bounce from that pullback or continue that uptrend, then what we would want to do is trade the yes shares to the upside because if it does bounce, there is a likely probability that it's going to close in these upper areas, and then vice versa. If we believe that it's going to bounce to the upside and it will not continue going down because the blue line has crossed above that tan line, then we would want to trade no on the shares to the downside because if it does have that bounce, it's not going to see those lower prices. Now let's talk about the S&P 500 weekly chart, and I'm going to move my face once again so it's easier to see. And at the very bottom of the chart, we're just going to focus on the areas where that line crosses. So here's an example. The blue crosses the tan line to the downside, and this is what happens. Ends up being right here in this area, and there is a pullback that follows that crossover. Here's another example. So the blue line stays below that tan line, and then it crosses above it, which happens to be in this area right here on the weekly chart, and then a push to the upside follows that crossover. And being that the market has been in a very strong uptrend since, there was no other time in which these lines crossed, so there are no other signals. Now let's structure the trades, and this time we're going to be going into the weekly contract. So the first example that I gave of the blue line crossing that tan line to the downside and there being a pullback, this is what we're going to want to do. So if it's going to pull back, then I would want to trade the no shares to the upside because we don't think that it's going to go to those upper ranges. And then vice versa. If we do believe it's going to pull back, trading the yes shares to the downside because if it does pull back, there is a likely probability that it closes in those lower ranges. And then now the opposite side of that trade. So if the blue line crosses that tan line to the upside, and we believe there is going to be a bounce to the upside and continuation of uptrend, then what we're going to want to do is trade the yes shares to the upside because if it does bounce, there is a likely probability that it closes in those upper ranges, and then vice versa. Trading the no shares to the downside because if it's going to bounce, we don't believe that it's going to see those lower ranges. So that was the S&P 500 daily and weekly chart. Now let's go look at the NASDAQ 100 daily and weekly chart, starting with the daily first. I'm going to move my face once again so it's easy to see. And let's look at the areas where these lines cross. So the first cross happens to be right there. And look at the area on the chart where this happens, right here. And then what follows? A nice push to the upside. And then the blue line remains above that tan line, and the first cross to the downside happens right there in this area on the daily chart. And what do you know? A short-term pullback to the downside. And the next time that these lines cross, right here, the blue line crosses the tan line to the upside, happens to be in this area right here on the daily. And then there is a nice push to the upside. And then there is one more crossover. The blue line crosses the tan to the downside, happens to coincide right here, which there is a short-term pullback. But as you can see, this one was not as big and didn't work as well. And that one is a great example showing that nothing works 100% of the time. It's all about the probabilities. Now let's structure the trades. So as far as the first example that I talked about where the blue line crossed over the tan line and we believe there is going to be a push to the upside, what you'd want to do is trade the yes contracts in these upper ranges because if it does have that continuation to the upside, it could see these higher prices and then vice versa. If we believe that it's going to continue to the upside because of the blue line crossing over the tan line to the upside, then we're going to want to trade the no shares to the downside because we don't believe it's going to see these lower prices. And now vice versa. If the blue line crosses the tan line to the downside and we believe there is going to be a short-term pullback, what we're going to want to do is trade the no shares to the upside because we don't think that it's going to get to those upper ranges, and then vice versa, trade the yes shares to the downside because if it does pull back, there is a likely probability that it sees these lower prices. That was the NASDAQ 100 daily chart. Now let's look at the weekly chart. I'm going to move my face once again so it's easy to see. And now let's go look at where those lines cross. So here's the first time that I see them cross. The blue line crosses the tan line to the downside, which would be a bearish signal, a sell signal. And where does that happen? Right in this area. And what do you know? There was a pullback from that area. It was short-lived, but there was still a pullback. And then here is the next time where the blue line and the tan line cross. This time, the blue line crosses the tan line to the upside, which would be a bullish signal or a buy signal. And it happens right here in this area. And there was a short-term push to the upside and a nice bounce from the lows right where those two lines crossed. And if you look at the lines on the MACD since, there was not a single other time in which they crossed. So being that they haven't crossed since, there's going to be no signals. Now let's structure the trades. Let's use the first example when the blue line crossed below the tan line, which would be a bearish signal or a sell signal, and we believe there's going to be a pullback. So what we would want to do is trade the no shares on the upper ranges because if it pulls back, it's not going to see these higher prices. And then vice versa, the yes shares on the lower prices because if it does pull back, then we believe that it has a likely probability of closing in those lower ranges. And now the opposite side of that. So when the blue line crosses above the tan line and we believe there is going to be a bounce or a push to the upside, that's a buy signal or a bullish signal. What we're going to want to do is trade the yes shares to the upside because we think there is a high probability of it closing in those upper ranges and then vice versa. Because we believe there is a bounce to come or there's going to be a push to the upside, we would want to trade the no shares to the downside because we don't believe it's going to see these lower prices. So there was a lot of examples, but this is how you can use the MACD to trade the event contracts on the NASDAQ 100, the S&P 500, daily and weekly chart. So that's it for the video. I appreciate you watching. Feel free to like, comment, and subscribe, and I'll see you in the next one.